You remember this thing about Main Street versus Wall Street? Man, Main Street was winning for like 1 week. 2025 is going to be characterized by one thing. It's going to be the golden age of grift. The gangsters are in control. The grift is alive. What I said in May was, gag in May and shrub away. You need to spend some money on protection for the summer. We could have like a mini repeat of April if they keep doing what they're doing. I think that
this episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. What's going on? Roundup edition forward guidance. Super excited to be joined this week by Chief Meme Strategist, Shrub Stack, the meme lord. Shrub, great to have you with us.
Yes, thanks for inviting me. Pleasure to be here. So excited. Yeah. It's gonna be like an only memes, only shrubs kind of day. Bring it.
I love it. Yeah, I mean, like I was just thinking, like the only guy that could probably outnumber the amount of times that they say Ponzi would be you versus Tyler. So
just to clarify, Tyler's descriptive word when he owns them are frontier technology companies.
Oh no, dude!
And Trump's is grift.
Wait, hold on. I got to defend myself here. Rocket Labs is a real company. They take shit to space. They're the second leader in launch. Dude, that thing was, I gave that to everybody at like, $10. Now it's 50. Come on.
Rocket Labs.
Just so you know, Shrub, there's a running poly market line, how long it takes Tyler every one of these podcasts to mention Rocket Labs. I think you can see it pouring out of his ears. He's so heavy in the bag.
The whole point is money's got to go to those frontier companies. And there's a lot of bullshit. There's a lot of sociopaths with fake companies. That one just happens to be real.
Actually, Rocket Labs is a great company.
Yeah. I did take some profits yesterday though. Just FYI.
All right. So yeah, the theme of this episode, just the great Ponzi-fication. Guess I've heard Tyler's version of this a lot, but I just want to start the conversation by just hearing about Shrub, where you're at in terms of your macro framework. So you've had this, I think you call it the gag portfolio, which has been a really interesting way to think about things. So I just have it up here. Hopefully we're not diluting your Shrub Stack Alpha a little too much here, but
I'll keep it high level. Just I won't go into each bucket, but I'll just keep it high level. So I started the year thinking I want to hedge against certain things. So I want to hedge against the lower dollar. Don't forget at the beginning of the year, I was coming out and saying that Trump is bad for the dollar. And that was like the most contrarian thing at the time because, everyone on Wall Street was saying that Trump is great for the dollar or, it's a strong dollar policy. And I think we had that discussion as well saying Trump was and is bad for the dollar. So I wanted to hedge against that. So I created this barbell portfolio of, EM assets and precious metals on one side. And then on the other side, I created the other barbell. I had what I call biotech or Rosemary's Baby because it's like the unholy offspring of, ultra long bonds and Cathy Wood. So I called it like Rosemary's Baby. But, that kind of, that's like Tyler's Ponzi's in reality. So basically it's stuff that, it could be unprofitable. It could be something frontier. Okay, they're Ponzi's. but so that's why I was like, you have to be hedged because things are, you want to be hedged for the short, for the dollar collapsing, but you also want to be hedged for the market going up, right? Because, a lot of people just focus on the downside, but they'll forget that, you actually want to capture the upside if it melts up. So that part of the portfolio was kind of like that, the more the more racy stuff. There's a lot of biotech in there because actually it's a very cheap sector. And then, you sprinkle some other themes like back in January, February, there was the famous meeting of Zelensky and JD Vance and Trump, where Zelensky forgot to give thanks, which, readers of Shrubstack would know that giving thanks is very important. So after we have a nice win. So, that meeting generated another theme, which was the European reshoring, because everyone's focused on the US reshoring, but, the European reshoring and the European defense budget was a very important theme. So that's part of the portfolio. So that's the fundamental part of the portfolio. And then, we started this big theme back in, after the inauguration, which was, I tweeted out like 2024 for me was the year of Yellen, which I call her affectionately as, Tamagotchi Yellen, because she's a, very simple reaction function like a Tamagotchi. Just wanted markets to go up to re-elect her guy, right? Or later her lady. So 2024 was a really simple year. I loved it, had a great time, just rode the wave of Yellen. So I was thinking, 2025 is going to be characterized by one thing. It's going to be the golden age of grift. So I called it for short GAG, because I actually use it so much. I'm like, just GAG. And it's going to be run not by gangsters, but by gagsters. So the gagsters are in control. The grift is alive. So then I was like, you know what? I want to capture a way to, I want to get the upside from grift without much downside. And that's where grift arbitrage was born. Where basically, I try to find ways to minimize the downside and just have upside, grift upside. So, low downside, grift upside. What else? What more do you want? And, there's quite a few ways to do that. And, that portfolio grew like a parasite. And now it's like half my portfolio. And, it rotates across names. But, just without giving too much away. But the obvious thing is that the connecting factor, it has to be someone, they have to be close to the administration or linked to the administration in one way or benefiting from the administration. So I don't really have much interest in anything outside that. And, that's what enables me to just sit on the beach wearing my expensive shorts and enjoy the summer. What I said in May was, gag in May and shrub away, because it could be a bit weird. So, that's the portfolio setup. Yeah. If you want to go on the macro setup, the macro setup is, it's so fuzzy. And that's why I've designed my portfolio in this like more of a carefree way that I can just chill and just write it, because after the big, beautiful bill passed, which was like an obvious, it was obvious we're going to run into it. We had to run into it. But after the big, beautiful bill passed, I kind of had the view that this thing about TACO was a bit overplayed, because all that Trump wanted to achieve was pass the big, beautiful bill. That was his main goal. And once he did that, then he could afford to be a bit more crazy, live a little. So, he lost tariffs. So what did he do after passing the bill? He just slapped 50% tariffs on copper, 50% tariffs on Brazil. And then he escalated with the EU, because, on the EU side, we were, the EU got 20% tariffs on Liberation Day. And then last weekend, that jumped to 30%, or 2 weekends ago, whenever it was. So it jumped to 30%. So the EU got a worse deal than Liberation Day, but no one cared, because now it's kind of like we're in the nothing ever happens TACO kind of thing. So I'm like, you know what? I kind of have to start getting a bit worried here. And I'm not worried like in this, in the traditional way we're going to crash. I'm just worried like we could have like a mini repeat of April. And, there's because, why did April happen? April happened because no one was prepared for it. And in a similar way now, people are like, the most consensus thing I'm getting is TACO. That's number one. Number two is, well, I don't need to hedge because, I've lost money on hedges the last 2 months or whatever. Or, I'm going to write more portfolio. And the worst one, by the way, is I'm a long-term investor. That's like the biggest horseshit, because, whenever you hear people saying I'm a long-term investor, it's like, oh, dude, you're going to sell at the lows, aren't you? So, so basically, all I'm saying and all I'm doing is I'm just making sure And again, like if you see the avatar, that avatar is wearing expensive shorts, physical shorts. So basically what I'm saying is you gotta, you need to spend some money on protection for the summer just to enjoy the summer. That's all I'm saying. I'm not saying it's the end of the line or it's the top or whatever. Because number one, we could get a shakeup on the tariffs, and number two, and by the way, this is actually a new one in my thinking, thanks to a Shrub subscriber that kind of piqued my interest. We were having this discussion earlier, saying, what happened last August? How did that melt-up end? It was the BOJ, right? And then fast forward a year later, so we have elections in Japan. The BOJ is doing some funny stuff. And then more importantly, who are the guys actually the most hawkish against Trump on tariffs? The Japanese. So, you know how the world works. The monkeys wake up at some point, and they always wake up at the last moment. So I'm just saying, if people have PTSD from last year and some headlines come out of Japan and they're going to be like, oh crap, the Japanese are going to do it again, like last year, they're going to shake up the tree. You could have, like, I'm not saying a 20% correction, but just a 5-10% correction is enough to shake people nowadays. And like I said, I'm not worried. My portfolio is like kind of, I'll lose a few percent. I'm not going to cry. Promise, I'm not going to cry. But that's the setup. I don't think it's a difficult setup, to be honest. I think it's a pretty easy setup. It's like, we had, some pockets of speculation are overstretched, but you can see a long-term story around them. It's a golden age of grift, so we're going to keep grifting. That's not going to change. So it all depends if we have like a shake-up from the tariffs, a shake-up from Japan, and that's going to happen in the next 30 days. So, you might as well protect yourself against that scenario and just let everything else run. It's fine.
What's your read on like the 30-year US bond being at like 5%? Are you worried? Does that give you shivers, or is that a sign that the policymakers are going to come in and try and do some weird yield curve control?
Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHFelix to learn more. Want to earn real yield on your Bitcoin without leaving the ecosystem? Echo Protocol is the first Bitcoin liquid restaking and yield layer built on MoveVM. It powers the BTC-Fi economy on Aptos, securing nearly half of all bridged assets on the network and minting over $200 million in ABTC. With Echo, you can easily acquire, hold, and earn on Bitcoin via ABTC, their yield-bearing Bitcoin asset. Echo already makes up around 70% of Bitcoin supply on Aptos, and it's just getting started. Learn more at echoprotocol.xyz. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Yeah, look, the thing with the bonds is, if we see what's going on around the world. So, the US is on fiscal mode. The Europeans are on fiscal mode. Ursula, the head of the EU, that I can't even pronounce her surname, she was talking about a 2 trillion package today in Europe. The Chinese are talking about fiscal package. So the whole world is on like fiscal mode. So I think it's natural that the bonds are not going to be good performers again. But having said that, you kind of want to see, for all these things to work out, the bonds have to be stable, right? So if we, my whole theory about Tamagotchi Yellen, and now that I call Tamagotchi Bessent, is that there is these central bankers. Yeah. So
there we go.
Yeah, there you go. So basically, Yellen, what did she do? So the central point about this thesis is that central bankers are like Tamagotchis. They're very, very simple creatures. And there is a red line that if it crosses, they panic. And that red line, we found out what it was in October, November 2023, when we had the bond sell-off. So when the yields broke above 5, or they were breaking out, even the 10-year was breaking out, that's when Tamagotchi Yellen got triggered and acted. And she did a very dovish QRA. So the QRA was, as we remember, it's the quarterly refinancing announcement, whereby she shifted from issuing more coupons to shifting to issuing more bills. So to a degree that she would have made Evita Peron blush, because she was like Argentina style. She's like, you know what? We're going to issue bills. We're not going to issue bonds. And that put a cap on the yields at that point. And then she teamed up with her buddy Powell, who came up a few weeks later and cut 50 bips, right? He cut 50 bips just shortly after. So there was a coordinated action that capped the yields. So fast forward to today, that 5%, does it worry me now? Look, if it breaks out, you should be worried, because it's how policymakers panic. There is a red line on all those things. And that red line might be 5, it might be 5.5, because we have the fiscal the fiscal stimmy on top. But that's when Bessent becomes Tamagotchi Bessent, because there's going to be a line, and that's why the next QRA is going to be very important. Because look, Bessent was kind of, man, this is like, my favorite quote that I use on Shrubstack is that once you realize it's all nonsense, it all starts to make sense. So this is like completely the case. Whereas this is like we live in kind of like a version of Animal Farm. I keep saying it, that basically the previous guys become the new guys. The new guys make the same thing as the previous guys. So Bessent was giving crap to Yellen for issuing more bills, and for the last 6 months. And now that it's his turn, what's he going to do? He's probably going to issue more bills. So if he does that, I reckon it's going to be taken up dovishly, and maybe he puts a cap on the yields. So as my buddy Paolo Macro says, the old boss meet what is it like? Old boss meet the new boss, or new boss meet the old boss. Same thing. So basically, that's the picture on the left side. That they are the same thing. It's Animal Farm. They're just picking up from the previous. So that's number one. So the QRA is what could actually put a lid for some point. But if you start doing all these crazy things, at some point they will lose control of the long end. And that's when you really have to start worrying. We're not there yet, because I think, I use this verb, like there are ways to fraud it. There are ways to like massage it. There are ways to play around with it. And they learned from Yellen, by the way. Yellen is the queen that made all this possible. Like, I think she's like the biggest financial criminal mastermind of our century. Like, these guys would not be as smart as Yellen to make this happen. And by the way, we give thanks to Yellen, because we made a lot of money last year. I have no complaints. I'm not here to judge. I'm here to make money. Just so I'm clear. So I'm just saying, like, these guys are going to make probably the same thing, and it's probably going to last, a few quarters. And, the one thing that could derail is, number one, is the BOJ, as we mentioned earlier. The BOJ could actually do some funky stuff with the like last year. That's number one. And, number two is we got a little taste of what would happen if they fire Powell. Because, they really, so this week, what was the most important event? The most important event was that we got a trial balloon that that Trump would fire Powell. And the reaction of that day was very interesting, because, so that's it, the trial balloon. So the reaction of that day was very interesting, because the consensus view was that equities would go to the moon. Like, I had I was just reading through my chats, and, people were saying, I don't want to be short, because the day that Powell gets fired, the market's maybe up 5%. And lo and behold, what happened? On the trial balloon, bonds sold off 1%, the dollar sold off 1%, but also equities sold down 1%. So I reckon if they actually remove Powell, that's going to be a proper shakeup for the bond market. And people that actually trade emerging markets would know that this is like a no-no. Like if you never go full Erdogan. You never go full Erdogan because he's the only guy who fires him, and every time he fires the central banker, the FX goes to the toilet, inflation goes through the roof. So that's I really hope they learned their lesson, and I'm just glad they did the trial balloon instead of going like all in. But you never know, huh? You never know.
Yeah, I feel like it's super underrated what could happen in the capital flight in that sort of situation. And in the same vein too, like, I don't know, we can open this discussion a bit more to the rest of the gang on here, but I feel like as traders, this is where it becomes hard, because when we look at all these, it just looks like they're running out of they're hitting more constraints basically in terms of the Ponzi games that they can play. And so you're like, okay, well, it makes sense to try to short the long end here, right? And try to capture that. But in the other side of your brain, you're like, oh, well, there's always, you're going to hit that panic level, and pretty quickly they're going to try to find out new Ponzi's that they could throw at this thing to try to bring it back down. And so it's like intuitively it makes sense to want to short the bonds. But then when you think about like the second order effect of that, which is that there's all these reaction functions, and that's where it's really hard. I'm curious, like Quinn and Tyler, how you guys navigate that as well.
I think that's what this really is everyone's figuring out bonds are worthless in a world ruled by fiscal dominance. Felix, you did an incredible interview this week with the guy from the Democratizing Institute, and just absolutely nailed it. But in that world where government fiscal policy just takes the reins, what the hell do you own a bond for after 40 years of essentially manipulating the system of debt? And the easier way to play it is just buy Bitcoin. That's just like buy crypto. And now what I think is going on is the evolution of what is debt after you absolutely annihilate your debt markets, both demographically, and you force everyone by mandates to invest in it, whether through insurance or endowments, et cetera, is you inevitably have to go find higher and higher yields. And I think that's why ETH is on fire right now, is everyone's realizing, okay, we've screwed up the fiat bond market globally now. And everyone goes from fiat, and that's why high yield bonds, junk bonds, HYG is at a new high, because everyone has to go out the risk spectrum to get yield. So then you go from, but they don't want the junk bonds because they're still priced in fiat. So you go out to Bitcoin, right? And you grab yield there in MicroStrategy or MSTY or whatever, all these Stork products. That's actually probably real yield you're getting there. And then if you go even further to ETH, I think what's happening is ETH is turning into the Mike Milken of our generation, where I think real yield will come in Ethereum. Peter Thiel's involved in Ethereum now. Like, he bought 9% of BMNR, which is like, that guy doesn't miss. So like, if you think that my evolution is, this is all volatility. When you smush volatility of bonds and smush volatility of stocks, that vol has to come out elsewhere. And it comes out in the frontier markets, which is, essentially what GAG is as well. We've all come to the same conclusion, is you've created a boomer Ponzi scheme in like levered fiat assets, and it just leaks out. That's just what's going to happen. But, you're going to have shocks to the system from time to time when you can't put the global, fiat genie back in the bottle, which is like, okay, we're watching Japanese 30-year yields at 308. They're going to probably have to do smash yields down somehow. Then their currency goes wild. Eventually, like when the vol goes absolutely nuts and things get wonky, which we might get a spurt of that because things have been so stretched. But I think all roads lead to just some like global yield curve control in the fiat system. I think that's sort of where we're heading. And they might not overtly say it, but that's sort of where I'm guessing we'll end up.
Yeah, on the Japan point, they have elections, and the risk is that more control goes to an even more liberal or spend friendly party, which is kind of funny that Japan could get more fiscally worse off, but that's the risk. So I think bond market wise, it, like you guys have mentioned, it's such a global phenomenon here. It's like every day we wake up and it's like, whose yields are popping off today? Is it UK? Is it Japan? Is it US? And then they all just sort of feed into each other. I still think the chances that I would assign much higher chances that Bessent does the Yellen tricks at the October QRA than this one, just because it seems like no one cares about it yet. So, and the market doesn't really. So why sort of use your bullets when it's not a problem yet? But I do agree they're going to have to do something, and most people are clued into that. The question I would have is, when that happens, do the same trades that have worked now work after? Because now everybody, it seems like it's pretty well aware, and everyone has piled into gold and Bitcoin and crypto and, you know, these fiat debasement hedges. But presumably, you know, if that happens in the next 3 to 4 months, inflation isn't going to be, you know, much different than it is now, which is quasi still problematic. And so does that just stoke things even worse? And do those, is it the same trades that work as have worked the last few weeks in anticipation? Is something I'm thinking about.
What do you guys think of this chart? You can go to chart 35, Felix. See, this to me is what, like, the existential angst of the global bond market is priced off this. U.S. long-term bond funds sustain heavy redemptions. Every single time you saw this, there was some sort of crisis. And I don't know how they solve this problem. Like, what in the next generation, you're going to have to mandate, there's going to have to be some legal law that says you have to buy long-term bonds, or Trump's going to say, hey, Japan, you have to buy these or we're not trading with you. I just don't, it's going to force, it's either going to force austerity, or there's just going to be someone's just going to take a hickey and have negative real yields by buying these bonds. And I'd be scared shitless if I was a boomer right now, and they don't even know they own this stuff. Like, it's all in Vanguard bond funds that worked for a generation, and they're probably down, you know, a little bit on them, but haven't realized for the past 3 or 4 years they're down big on them. So I don't know. What's your guys' perspective on this? Is this going to be just like a wake up? And then if you go to the next chart, this is, you know, home affordability. This is obviously why they want to lower rates, but if they actually, how does this reconcile? I don't know. My bet is on Bitcoin, but I don't know how they reconcile these imbalances.
Yeah. Shrub, who do you think is going to buy bonds?
They have to pay the interest in Trump coin, and then you have buyers lining up at the door, and I think that solves it.
Yeah, but to your point, who's going to buy bonds? That's where Tyler's point comes in about yields breaking out. Like, there has to be price discovery at some point. So that's why, you know, yield control works to a point, and that's why I think, like, you know, they might be cute with the QRA. Like, to Quinn's point, it could be this one or next one. But, you know, these guys are going to be we have another 3 years and a bit, right, left. So how long can they patch things up? Like 2 quarters, 3 quarters, 4 quarters? Like, it's obvious. Like, look, to me, the thing is, I see my, you know, retail readers, and I interact with retail investors, and they get it. You know, they get what's happening. So
yeah, but if you ask any institutional hedge fund, bro, they have no idea. It's like, oh, this trading at 22 PE.
Yeah, exactly. Yeah, exactly. Or, you know, we watch the downside, and we want to be beta neutral, and we're always running like 10% beta neutral. It's like, dude, like, they're just literally printing out of their butts for the last 2 years, and you're running like a 10% beta neutral book. Come on, like.
Hey, dude, they use really big words and acronyms and stuff, so they sound really smart.
Yeah. Whereas, you know, it's the bell curve mean. Whereas, you know, I was speaking with a reader of mine today that, you know, was bet big, bet the farm on Hood. right? Because why? Because Hood shifted into crypto. Nice and simple investment thesis. Because I think retail just has a clarity on these things. They have a clarity on the themes, but I think they also have a clarity that we're in debasement period. So that's why, crypto is doing what it's doing. That's why Bitcoin is doing what it's doing, and also Ethereum, like you said, it's waking up. And some other things I don't even know the tickers for, like Ripple. I noticed today that Ripple is 200 billion. I don't even know what it does. So anyway, but
you're not alone.
God.
People
Yeah,
worked in the
nobody
industry
actually
for
knows what
10
it
years
does.
know.
Yeah. So I mean, the thing is, I listen to a lot of Felix's pods on crypto because I'm such a boomer. I literally my knowledge on crypto relies from Felix, forward guidance, and like a couple of crypto friends. So, the thing is, retail gets it. There is a debasement going on. And I don't think, to your point, who's going to buy the bonds? There has to be one, price discovery. And number two, it's not like the administration is helping themselves to find buyers. If anything, they've just, disenfranchised the obvious buyers, like the Europeans, the Chinese, and the Japanese. Like, these are the three countries with the worst demographics that should be piling into US bonds. And they're not buying anything. Like, they're buying their own crappy bonds at like half the yield, right? And I think one thing that we haven't discussed is the dollar. That also plays a big part because like I said, I've been bearish the dollar for the last 7 months, and I see a lot of people trying to be contrarian and say, "Oh, it's the bottom," and the dollar is like, no, just step back and think about it 3 years out. Like we said, these guys are printing. It's the golden age of grift. Forget about the counter trend rallies or whatever in the dollar. The trend, if they keep doing what they're doing, I think the currencies are going to end up worthless. So if you start with that, if you start backwards, if the currencies are going to end up worthless, what do you do? Like, I'm a boomer, so I want to own some emerging markets. I want to own some platinum. I want to own some, miners, commodities. But, the new generation, like you guys, I understand why you're piling into Bitcoin, for example. I get it. So I think people are going to be reacting in their own way. And I think the wrong way to react is to actually own bonds, even at these levels. Like, I just don't see it. And by the way, shall I tell you the worst case scenario? The worst case scenario is that they do what they actually said they're going to do. And what they actually said they're going to do early on was induce a recession so that people buy their bonds. So, we have this meme that I didn't bring it this time, but it's the meme that where everything burns on fire, everything is burning. And Bessent or Yellen are saying, if you don't buy my bonds, I'm going to torch your equities, and then you're going to buy my bonds. Because the only way you actually get people to buy bonds is if you induce a recession. That's number one. Or number two, you bring fiscal prudence, and like there's no chance on earth anyone in this administration is going to bring fiscal prudence, which kind of leaves like option one or the YCC case. And the YCC as well. I mean, man, there's so many bonds out there. The YCC can help to a point, right? So that's why, like, it's a pretty tough setup for the bond markets.
Can you afford to have a recession though? Like, my general rule of thumb is we are gonna grow our way out of this one way or another.
We lasted like 1 week, man. We lasted how long? Like,
Yeah.
You remember this thing about Main Street versus Wall Street? Man, Main Street was winning for like 1 week.
36 hours.
Yeah. 30% saying this is Main Street's turn. Like, dude, they literally lasted like 1 week. They lasted as badly as a 0 DTE. they lasted like just insert your own punchline. But like Main Street, man, like rest in peace. This is Wall Street all over again. So to your point, will they engineer a recession? Nah, man, I don't see it. Like, they tried it, they lasted a few days, it didn't work. Now they're just gonna grow their way out of it. That's it.
Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHX Felix to learn more. Let's talk about BTC5 and why Echo protocol is critical to it. Echo is the second largest protocol by TVL on Aptos. It secures nearly half of the bridged Bitcoin on the network, with $200 million plus in APTC already minted. So what does Echo do? It lets users restake Bitcoin, earn yield, and participate in BTC5 apps on Aptos, all without giving up control of their core Bitcoin exposure. With just a few clicks, you can mint APTC and start earning yield, backed by the most dominant Bitcoin layer in the Aptos ecosystem. If you're looking to put your Bitcoin to work in a secure, high-growth environment, Echo Protocol is where BTC5 begins. Learn more and start earning at echoprotocol.xyz. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Because I don't think we can afford to anyway. Like the deficit, 6% deficit, if you had a recession, that would blow out. And then it would be, I think it would be devastating to the currency. And then
It'd be insane.
You get this thing, it's a third world country thing where, the currency absolutely dives, but then all the Japanese money repatriates and sells debt because the currency is diving so much. And then you have just like a complete, capital just goes flying out the door and all the store value, pristine collateral treasuries. And maybe this is what sparks the entire move into this new crypto system. But I don't know. It's starting to scare me because how long can you Ponzi for before you wake up and you say, like Shrub was saying, retail's picking up on the Ponzi now. And, this is Weimar Germany type shit where, prices of stuff keep going up and they're telling you, there's no inflation and you should, maybe you should allocate to some bonds. Like, come on. This is the end game. We're watching the end game right now. I just don't know. It could play out really ugly, or it could play out like, we're clearly feeling good after this run in crypto here. And maybe this is the second inning of the crypto, money slowly flowing out of the TradFi sector into, crypto. And this is our big chance to actually gain some wealth from, greedy boomers like Shrub over there.
I think there is still this risk, and what Shrub's fire meme describes as just a deleveraging. And that's what happened in April. And eventually the deleveraging got too acute that bonds then went the other way for the reasons you pointed out, Tyler, because everyone said, oh shit, equities are down 23%. That just means that revenues and receipts got cut by probably the same amount. And so we're not at 7% deficit, we're at 10. And that's without any of the stimulus to get us out. So I do agree with that, that evaluation that over like the long term, they're just going to smooth it. But I do think the market will just continuously have these mini deleveraging scares that will catch people over levered, people off sides, because they will need it. Like the best, the point you make, Shrub, the best thing to stop the 30-year from price discovery is manufacture some sort of growth scare. And the trade that I think would be, if there's ever pain trades, everybody loves to talk about pain trades, but I still do think that would be just a broad deleveraging. And I don't know what the dollar does, but where they do try to force a bit into bonds and everything gets hit, even gold and these store values that have run, maybe the dollar slightly strengthens for a couple of days and then rolls back. But I agree, the ultimate where things are headed is just worthless fiat. It's just managing the bumps along the way.
Felix, can you put that meme, please, of the astronomer CEO? Because that's my favorite meme of the week.
Yeah. Dude, this one's incredible. Hold on.
So can I just give the quick background on this? Because, like you said, I'm a chief meme officer, so I'm the CMO here. So this is the best meme of the week. The CEO of this company that I've never heard of called Astronomer. He went to a Coldplay concert with his head of HR, who was his mistress, and both married with other people. And as they were just hugging each other, the camera from the Coldplay concert just picked them up, and then they looked so happy initially, and then they were just hiding everywhere. So I have so many questions here. Like, this guy, of all the places he could have taken his mistress, he just thought, I'm going to go to a concert with 50,000 people and get some good seats as well, just in case. So, and then he gets caught. And also, like, Coldplay, dude, like, seriously? Anyway, well, whatever. So, anyway, so, so, so as I was watching this, I was like, oh my God, this is going to be like the people in the market. If the market actually pukes in August, this is how people long Ponzi's are going to be like just before they get margin called. And I was like, this is just a beautiful meme for the week. That's my whole contribution value add here, guys, by the way. That's it.
All right. Thanks, Shrub. Good to see you. Bye.
Great. Yeah.
No, I think it's so true. Like you always got to keep your wits about you for sure.
Today is a perfect example because, all the news was obviously bullish. It was a sell the news event on all these, Genius Act, all the crypto things that passed. And now things are down a little bit today. And I think that's two things, obviously the Japanese 30-year yields and the sell the news. Everyone's leverage was built up heading into this event, and classic retail over leveraging themselves. So that's got to get cleared out before we, resume our ascent. I think things do get a little rocky towards August though, because obviously July is like the greatest month for low volatility because everyone's on vacation, as we discussed last week. But I don't know. The corporate credit spreads are in so much, falls in, and there's some funky things happening. So just be prepared for some sharp, quick drawdowns the next couple of weeks.
Yeah, I think, look, VIX is low. So that's why, like my avatar is wearing expensive shorts. So, the shorts are not that expensive to hedge. Like you can buy cheap hedges for August and just chill. It's not super cheap. It's not as cheap as last year, but it's not bad. Even like VIX 15 for some known risks. Like it's the first time that you can actually hedge for known risks cheaply because we have the August deadline, right? And we have the Japanese wild card. So I don't know. I think it's not a bad time to just, I call it a blood sacrifice. So you're basically just giving a blood sacrifice to the gods. You're just telling them, thank you so much for all the tendies you have given me. Here's a blood sacrifice.
I love that. It's so true. And my favorite thing, this is, so if I was obviously in the hedge fund world for years, but one of the funniest things, it's like clockwork with these beta neutral funds, is they manage to the VAR. So like as vol goes up, they continue hedging. So it's like you can see it in real time. Once something will change in the market, and then all these hedge funds will keep racing to buy downside protection. And we're probably, and then all the downside protection they bought in like March and April has been slowly weaning off here. And now is actually the time you buy downside protection because the vol is so low. So on the S&P and Qs.
Yeah,
and
I agree. I mean, look, hedge funds, unfortunately, I keep making this point, and it's very difficult for people to appreciate how dumb this industry is. They're actually, some of them are actually forced to hedge, right? Like you said, like, their exposures grow, or so they have to hedge. You're talking about like the smartest people in the world just having to do something that's counterintuitive. So it is what it is. It's the game.
The one thing that I don't understand is like, how do you underperform? Like net, I've asked this question so many times, but net of fees and hedge funds, if you're not really taking risk and outperforming, like the average hedge fund's up like 5%, like you could get that just, buying a short-term treasury. But net of inflation and then net of fees, there's no way these pensions are making money in real terms. And yet they go into these meetings and they all wear their ties. And it's like, I just think this is where you have to be out on the risk spectrum, and then you get the chance to hedge to the downside. Now that makes sense. But you have to be out of the risk spectrum because you have to make an 8% hurdle rate with all the dilution of the currency, inflation, and everything all together. Yet these hedge funds don't. And I just don't understand the value. Like maybe it's just like you're playing not to lose is what's happening with all these pensions. And I get that. So
yeah, I think it changed. Yeah, look, I think the game changed. Like when I started in the industry, I was at a fund that was $1 billion, in 2006, and that was one of the biggest event funds. Fast forward today, 2025, like Millennium has like a ton of 1 billion pods within it. So whereas we were one of the biggest players in 2006, now 1 billion fund is nothing compared to Millennium. And if in fact, Millennium has dozens of these $1 billion things. So basically, it just changed in a way. I think they're just like they're fee generators now versus alpha generators. Like there's very few hedge funds that are just pure in their, like differentiated. Like there's a lot of good guys, and I'm actually really blessed that I have a lot of readers in the industry that they do like really differentiated things. Like I have EM guys, or special sits, or proper arbitrageurs. Like you can see there's pockets of small funds doing some really cool stuff. There, even some specialist short sellers. That's very few left, by the way, because the ones that are left are actually really, really good. But these other ones, I just call them like hedge fund supermarkets. They're there to just generate fees. It's a place. Think about it this way: it's a place where the big American pension fund that has 100 billion is going to go to Blackstone to put some in private equity. It's going to go to put some in private credit, and then it's going to say, "Oh, I want to put 10 billion in hedge funds. What do I do?" They go to the small ones and they say, "Well, we don't have much capacity. We can take 50." And the pension fund is like, "No, I want to put 5 billion." Well, you can only do that with like just a handful of big funds, and that's why this happens, and that's why there isn't that much alpha. There's some real killers, like I like memeing Ken Griffin, but if you see his returns, actually, like the guy is really, really impressive.
Yeah,
so,
you got to give it to him.
So you got to give it to him.
He's also seeing all the retail flow on the other side of his business and probably front running all that, those trades.
Exactly. Yeah, exactly.
I don't know how that actually is legal by any means.
One kind of short-term risk that I've been interested in is I just want to pull up a chart of inflation swaps that are starting to take up meaningfully. I'm curious how all three of you guys thinking about this, but like on the top line, obviously we've had tariffs for a few months now, and some of the top line data looks okay. Like we've had the CPI print this week that came out pretty okay, mostly because of the core CPI and services. But when you just look down into the deep in the weeds data, you can start to see that it start to percolate. Like core goods surge pretty significantly. And then you look at inflation swaps here, which are just really starting to accelerate. And, this has been a pretty lackluster market for the past couple of years. It's been pretty benign, but this is something like when we talk about what could come in August, if these continue, I feel like that could be a pretty interesting catalyst. I'm curious what you guys think.
Yeah, the market, equities and other parts of the market are usually pretty slow to react to this type of thing. And my guess why people haven't cared is because commodities haven't really done anything. At least the ones that obviously metals, every metal has gone through the roof, but the industrial and OPEX commodities that factor into this, between the OPEC cuts and maybe some demand weakness in oil and other parts of the complex, I think it's all traded pretty benign. But, if you were to see something like that kind of start to heat back up, then I think people would be a bit more concerned. Frankly, I think the Trump administration and most market participants at this point, I believe, are coming around to the view that the growth issues of tariffs, like the growth headwinds of tariffs, negatively being a consumption tax. If you raise sales tax or any other consumption tax, generally speaking, that's not inflationary. Tariffs have another component, obviously, to it, but I think it's becoming more consensus that tariffs are first and foremost growth negative in the near term, and maybe long-term inflationary, whatever. But I think people are starting to agree that the growth stagnation outweighs the deflation. And that's part of the reason I kind of think, in addition to getting the bill passed, why Trump's rattling the tariff saber so hard again is because ultimately, I think they do need to find a home for these bonds. And we've seen, I guess, more slack on the growth side come through as things have surprised to the upside on the hard data. And so maybe they're feeling a little bit zealous. They think they can extract. I mean, shit, I was saying this is like a shrub line, but he announced 50% tariffs and the market was up that day. So why not announce 100 to like just balance the budget? The market's never going to react. Like get rid of the deficits. Yeah. So, I mean, who knows what he's going to do?
Yeah, but that's exactly my thesis, by the way, that he becomes emboldened to just ask more and more and more until it breaks. So the moment it breaks, I mean, look, the Powell trial balloon, in 1 hour, the market was down 1%, and they just walked it back in 1 hour. They didn't even let it run like 6 hours or half a trading day, literally 1 hour. So, to Quinn's point, it's basically, he's going to go hard. And then at some point, until something breaks, and then we have to see how quickly he retracts it.
This is where the market should not be this centralized. You should not be able to even do that. The fact that like those types of headlines can they can plant it and then they can walk it back. There should be so many counterparties existing, but every stock moves the same direction. It's all all trades together. And it's really scary. That's the part that's the most scary to me, is that I think it's all just one volatility trade at this point, minus a couple outliers of like, the frontier stocks that are in secular growth mode. In that's just really a a problem with the system, is when you can have that much impact off of like two headlines and change the game. You change the rules on the field intraday. It's nuts.
No, look, I think the other asset class that actually has alpha is grift. So that's why I just keep saying like grift or gag is its own asset class. I mean, I'll just give you an example. A couple of days ago, I noticed a massive call buying in Lithium Americas, like massive. They trade like 36,000 contracts. $1 million for 1 month expiry that never trades. And I was like, I called my mining guys. It's like, guys, anything going on in lithium? It's like, no. Called my buddy Powell. It's like, dude, anything like something really suspicious going on here. I let it pass. Then the next day, there was an announcement that the US is going to put 93% tariff on battery metals from China. I'm like, oh, okay, I get it. so then there was this other biotech specialist on Twitter, the sheep of Wall Street, good guy for biotech. He was, a few days ago, the pharma sector was selling off. And then the next day, it was announced that there's going to be tariffs on pharma. So the guy said, the good thing about this administration is that I can find a day later why my stocks were selling off the day before.
Yeah, so, you already know it when it diverges. Yeah. That's the most messed up part about the whole thing. It's like, why is a stock down that all its peers are up, and it's clearly they're probably doing a secondary and it's coming after the bell, and you wake
there's
up,
like that. Yeah, the day in June or whatever, when it came out 2 days later that they signed something with China, and Lutnick's like, oh yeah, we did that 2 days ago, and you see like randomly that morning everything's up, and everyone's like, that's a weird like 1% pop on no news, and oh yeah, we did it 2 days ago. We told Wall Street about it. Like, oh, you didn't hear?
Yeah, exactly. Oh, you missed the memo. You guys are not. Sorry, you're not getting my Substack.
Yeah.
You're not in my Discord. You guys are not in my Discord. Or the Signal, the Lutnick Signal trading room. I don't know.
Yeah, we need access. We need to befriend. Maybe we just need to hang around the Pentagon bars a little more, and we'll get Hegseth there.
Or dress up as pizza boys. Maybe dress up as pizza boys. Yeah. Anything for
we'll start a Domino's franchise in DC.
Let's talk about this one last Ponzi thing. This is the slide 39. White House readies order to bring private equity to 401ks. Like, if you haven't realized at this point, not only is crypto, going to get into 401ks, but private equity is going into 401ks. This is an outright like market go up no matter what. Even if we have a really harsh pullback here on like a vol, NASDAQ versus IWM spread reversion trade or whatever the hell it is, because all these systematic things are so stretched. They're going to come in and there's going to be policy after policy after policy, especially because millennials and Gen Z are poor as shit and don't own anything. They're going to need to offload, boomers need to offload their bags. This is exactly one of those things where it's like private equity clearly probably struggling because mark to market, it sucks. And, they need to stew demand. This is exactly what happened. This is like a tale as old as time, where you just open up demand and then it creates these massive imbalances. And I just think that's just not going to stop for the next 20 years. And we're just in this Weimar America market go up type scenario.
But don't worry, it's Main Street's turn. Don't worry. They're going to get stuffed with worthless private equity vintages in their 401ks without even knowing. But it's their turn. Trust me. It's their turn to buy.
I always think about Ben Eifert has a quote. You're just like, anytime you see somebody pitching something that says they're democratizing something in finance, just run away.
So true.
Democratizing supply.
That was Chamath night, right? Chamath in 2021. I think he was saying democratizing finance. I think so.
Exactly.
But I agree with you. Yeah, you see that, you have to run away.
And SPACs are coming back. They're democratizing access to, cool private companies. Gotta love it.
Frontier companies, as you would call them, Tyler. I got this frontier company. We buy a scam NASDAQ 1 million market cap and then we load it with shit coins. And
okay, I gotta say this. So I'm not saying buy shit codes that don't do anything. If it's a real company, then you want to buy like industries like space, industries like AI infrastructure, industries that actually do something, not just some made up thing. Like
so not an XRP treasury company.
Yeah. Although, I will say everyone's trying to fade these treasuries.
See, he can't help himself.
not XRP, but it's the treasury companies. I think that's, dude, all they're doing is it's a bond trade. They're arbing the vol of different systems. That's all they're doing. And I mean, Saylor did it first. The first time, like, he issued a bond, he created, Bitcoin as collateral. And that's all these are, is you're actually allowing, these investors in the TradFi system to get yield. That's all it is.
I think that's fair for MicroStrategy, but like these new ones that don't even have access to debt like markets, like they're not issuing converts. It's just like at the market equity issuance. I think that's a different story. I don't know. I think Shrub's a big hater of treasury companies. What's your read there, Shrub?
Yeah, look, I'll tell you where I differentiate the two. So I'm a hater of these shitco micro caps that they trade at 1 and then they do the deal. It trades at 10. The pipe was done at like 2, but it trades at 10. So implicitly, that's like a 5 times NAV. So that's kind of bullshit. I mean, those are like really, really dangerous. And I hate that because, the smart money is in the pipe. So the pipe guys are going to make a lot of money. So that I hate because the retail doesn't do the maths. Everyone's maths illiterate right now. They just depend on ChatGPT for simple arithmetic. So buying something at 5 times NAV, bad idea. But then you look at something like, even on the SPAC side, on the SPACs, we had the Pompliano one, which was lukewarm, below average. Then we had another one that was below average because, the deal wasn't structured well. But then Adam Back came out, Adam Back that came out like yesterday, and he did a deal with SIPO, which I was long from before, by the way, so I'm still long it. And that's trading at like 30. So the deal structure was actually it was very clean and good. And now it's trading at like 30% premium to NAV. And as a no coiner, I actually sat down to think about it like philosophically. And I actually get why something like MicroStrategy or, Adam Back's vehicle could trade at a premium. And the reason is what Tyler said, like number one, they generate yield, but let me just step back. And I was debating about this with someone. So I used to be a banks analyst for a brief period. So banks traded a premium to book. What's their book? Their book is shareholder equity. Where is their shareholder equity? In treasuries. Are treasuries worth much? Not really, but they yield 5%, so it's safe collateral. Okay, great. Now, if you think about MicroStrategy or Adam Back's vehicle and be a bit like adventurous in your thinking and the future. So, okay, they generate yield today, but imagine if in the future this whole system crumbles, the financial system crumbles in a way or gets diluted. You could have these vehicles being able to lend against their Bitcoin. And then if you lend against your Bitcoin, you become a financial services company. And then you're justified trading at a premium to book. And by the way, don't listen to me because like I said, I've learned everything on crypto by, listening to your show. So I'm just trying to I'm trying to think about it as a boomer and think about the future based on, our discussions is I can see okay, the FHFA is considering giving mortgages in Bitcoin. So imagine if they start giving mortgages in Bitcoin. So it doesn't matter if you hate Bitcoin or you hate crypto, they're going to do it. Okay. So if they're going to do it, then what stops like MicroStrategy or Adam Back saying, you know what, I'm going to do a Bitcoin backed bank and I'm going to lend as well in Bitcoin. So then they're going to generate a yield. And then if you lend in Bitcoin and the reserve currency is Bitcoin or the reference currency is Bitcoin, then you can justify putting leverage on the Bitcoin. So then your ROE is not your 5-6%. It's going to be much higher because let's take a step back again. Banks nowadays are levered 20 times. Back in the GFC, when I was short all that crap, they were levered 100 times. So they had a 1% equity to assets. So they were levered 100 times, and that's how they would generate 10% ROE. So now go back, fast forward today, and what's the yield on Bitcoin? 7-8%, but that's without leverage. It's very little leverage. The only guy who has real leverage is MicroStrategy, and it's not even that big. So the ROE right now, if it's 7-8% without leverage, and you imagine a world where they lend out in Bitcoin with reference of Bitcoin, and you put leverage on the equity, you can see these things trading at a serious premium to book. And by the way, this is the first time that I'm actually vocalizing this thinking. So, feel free to correct me if I'm wrong. I'm just trying to be like, just see a scenario out in the future that this can play out,
There's so many different ways to think about it, but that is just brilliant. It's why, I say like Bitcoin and balance sheet is worth more than, Bitcoin and ETF, because in the ETF, you're actually getting charged fees. And if you discount that, so it makes a lot more sense on a balance sheet to borrow against it and you utilize the yield. You can do a lot of things. I mean, the biggest thing for me was number one is, Saylor obviously borrowing against Bitcoin. But then when the futures and derivatives market open up, you can generate a yield selling puts. It's why like the vol slowly will drop over time with Bitcoin, because the deeper the market, the bigger the market cap, the more and more yield you can generate off. And this is any asset. You could do this on any asset as the access and awareness and network grows. This is probably the same thing with, Amazon or whatever over time is super volatile. And then derivatives market opens up, gets less volatile, and you can sell insurance on it. That's how assets go from frontier assets to, secularly stagnation assets. It's basically a giant yield play. And so that was my point about you're just opening up the Mike Milken yield on all this stuff, which Shrub came at it from a valuation perspective and equity, which is probably smarter than me. But anyway, we end up
that was over a few drinks with a friend that I was just thinking about it, to be honest. So it's really work in progress.
I love it. You got to think about these things differently. The other we had this huge argument in my office back in Fort Worth like a year or 2 years ago with Mike Green and my old boss Mark Hart about what is Bitcoin. Like how come you can value artwork, like artwork can be worth hundreds of millions of dollars, and then this Bitcoin thing is it is whatever you say it is, but there's really just there's fundamental principles of owning assets, and it's access, awareness, use as collateral, security and custody, and then potential for price appreciation. That's actually the basis of owning any asset, whether it's financial or artwork or anything. And I think people need to get back to first principles on this stuff, which is like that's really why you own things.
All right, guys. Well, I think we can leave it there. Shrub, really appreciate you joining us. That was a ton of fun.
Thanks,
I
man.
knew this would go well.
Great fun. It's been a pleasure chatting with you guys. Fantastic.
Yeah, man. Yeah.
We'll have you back soon.
Yeah.
Please.
Yeah.
Yeah.
Enjoy the beach with your expensive shorts.
Thanks, man.
All right, guys. Take care.
See you guys.